Hi, everybody. Welcome to another episode of the 7-Minute Takeover, where we chat all things acquisitions. We're your hosts. I'm Liz Prey.
I'm Eamon Gamble.
Today we're tackling another myth buster. What is preferred, asset sales or share sales? Eamon, do you want to take us through? What's the difference?
Okay, so this is something that comes up when you're negotiating a deal and you think you've got a structure, and then the lawyer asks, well, are you going to rather this be an asset or a share sale? Or maybe the seller asks it, and you don't want that to be the first time you've thought about this topic. So we're going to talk about the difference between the two and what generally is preferred by buyers, sellers, and how that differs on both sides of the Canadian and U.S. border.
So before we get into the first myth, because we've got a few segments today, can you explain the difference between what is a share sale versus an asset sale?
Yeah, so a share sale, or as is commonly referred to as a stock sale, is where the buyer is taking ownership of the entire company, warts and all. So you're buying the assets, you're buying the liabilities, you're inheriting everything that comes along with it, including contracts, employees, potentially undisclosed liabilities. You get it all. Now, with an asset sale, while it can be structurally very similar, where you're still taking on the business, don't think about it in terms of just taking the inventory or the accounts receivable. You can get everything, but it is more of a selective process where you say, I am going to take these employees, these contracts, this lease. And so when you're negotiating the deal, all of those assets pass from the seller to your new company. You're not buying the company itself.
Okay, so it's commonly heard that sellers prefer share sales. Is this a myth or true?
This is a good one. So it's going to depend a lot on the seller's personal tax situation and whether they're in Canada or the U.S. So the reason that this myth is common is that in Canada and the U.S., there are some tax benefits to sellers when it comes to realizing capital gains versus income. In Canada, sellers will ideally benefit from the lifetime capital gains exemption, which is north of $1 million, meaning that if they sell, have a company sold in a share sale for $1 million, the capital gains tax on that entire amount is sheltered. And so they can save anywhere between, on that size of the transaction, about, maybe 250 grand in tax. And if there's multiple owners and the transaction's larger, you could be talking in the millions of dollars.
Spread out across the parties.
Spread out amongst the sellers that they're saving in tax. So that is a huge incentive. In the US, there's something similar where some of the share sale gains can be taxed at lower capital gains rates. And so they benefit as well from that.
So they have to qualify for this exemption, though.
Here's the trick. Not every seller knows if they qualify. Some may take for granted that they qualify, but they may not. And that's the last thing you want to have happen is be halfway through a transaction and the seller realize, actually, I've got too much cash on the balance sheet, or I've got too many non-operating assets on the balance sheet. And so before you decide whether you should go with a seller or a share or an asset sale, you may, as a buyer, want to be talking to the seller to see, hey, if you talk to an accountant, are you actually going to qualify for those exemptions?
Okay, so what I'm hearing from you is that not in all cases is it going to be better for the seller to have a share sale.
Yeah, we see in Canada, it's the majority of transactions, call it in the 70 to 80% range in this market, are share sales. And in the U.S., the number's actually reversed, and we'll kind of get to why that is, but it's closer to 20 to 30% of deals in the U.S. are share sales.
Okay, so next part of the myth, do purchasers always want an asset sale?
So this is the myth, right? A share sale is better for the seller, an asset sale is better for the buyer. So where that, we'll call it myth, is coming from is that buyers, when they do an asset purchase, benefit in a few different ways. One is that they will not be exposed to any undisclosed liabilities. So if a lawsuit comes up after the transaction closes, an undisclosed tax liability, a number of these, a vendor dispute arises after a transaction is closed, the buyer is not responsible for any of those. So it can be a huge weight off their shoulders just to know that there's not going to be any of these skeletons coming out of the closet. The other benefit is that if it's a CapEx heavy business, or even if they've got any capital assets at all, you get to rebase those assets and start depreciating from a higher asset base. And so theoretically, your net income is going to be lower, your tax bill is going to be lower in an asset sale versus a share sale. The other benefit is that you get to kind of pick what assets you want and you don't want. So you don't have to take all or nothing. You can be a little bit selective in terms of what you actually bring over. Now, there are some downsides. There are employee contracts that may need renegotiated and other aspects that may make it less attractive than it initially appears.
So even though an asset purchase could be less risky, there can be some tax implications to the buyer as to why you would want to do an asset purchase. It can also open up more complexities and more work and due diligence from a logistics perspective, because all those assets have to be turned over.
And I think this, if we can call it myth number 3 of today's session, is that asset sales are always simpler than share sales. You may hear that from due diligence partners, accountants, and lawyers who say, yeah, you don't need to do as much homework into the target if you're doing an asset sale because you don't get any of those undisclosed liabilities following you along. In reality, asset sales can be a lot more, or asset purchases can be a lot more complex. Who knows if that government license that the target company has is transferable to you? Who knows if that lease is transferable to you?
Getting extra permissions to transfer those agreements?
The time that it's going to take, the legal expertise it's going to take. In addition to that, you need to renegotiate HR contracts with every single employee.
All before closing.
All before closing. And so they actually can be logistically quite a bit more complex.
Okay. So the myth being that buyers always want an asset sale versus a share sale. To bring it home, it sounds like in both cases, it really depends on what's in the best interest of both parties, and to really explore what's the right path for both parties with your advisors, your accountant and your lawyer are part of these conversations. Every situation is unique and different, so it's not always a blanket one or the other. Look into it, dig in. Any other pieces of advice?
Yeah, that's exactly it. That's why we see a mix of both asset and share sales on both sides of the border, is that for any given situation, one can be better than the other. So make sure that the seller's certainly talking to their tax expert. And then even as a buyer, recognize that there are going to be costs and risks even associated with a quote unquote simpler asset deal.
It's a big decision and a big part of the deal structure. So dig in, ask lots of questions, and make sure you're working with the right advisors. Thanks, Eamon.
Thanks. See you next time.
Thanks for tuning in. If you enjoyed the content, please be sure to subscribe, follow us on social media, and check out our website at villagewellth.com.